Introduction. The world economy is subject to periodic fluctuations, marked by phases of growth and contraction. Economic crises, characterized by severe disruptions in financial markets, widespread unemployment, and declining economic output, represent significant challenges with far-reaching implications. This article delves into the various aspects of world economic crises, examining their causes, impacts, and notable events throughout history. 1. Causes of economic crises. Economic crises can stem from a myriad of factors, often interconnected and complex. 1. Financial speculation and bubble bursts. Speculative bubbles, fueled by excessive optimism and investments in overvalued assets, can burst abruptly, leading to market crashes. 2. Financial instability. Fragile financial systems, characterized by excessive leverage, inadequate regulation, and systemic risks, are prone to triggering crises. 3. Macroeconomic imbalances. Persistent trade deficits, unsustainable levels of public and private debt, and currency mismatches can destabilize economies. 4. External shocks. Events such as oil price shocks, geopolitical tensions, and natural disasters can disrupt global economic stability. 2. Historical economic crises. 1. Great Depression, 1929-1939, the stock market crash of 1929, followed by bank failures, widespread unemployment, and a severe decline in global trade, marked one of the most significant economic downturns in history. 2. Global financial crisis, 2007-2008, sparked by the collapse of the housing market bubble in the United States. The crisis quickly spread globally, leading to bank failures, government bailouts, and a prolonged recession in many countries. 3. Asian financial crisis, 1997-1998, currency devaluations, speculative attacks, and unsustainable levels of debt triggered a severe economic downturn in several Asian economies, including Thailand, Indonesia, and South Korea. 3. Impacts of economic crises. 1. Unemployment and poverty. Economic crises often result in job losses, income declines, and increased poverty rates, exacerbating social inequalities. 2. Financial market turmoil. Stock market crashes, bank failures, and credit crunches contribute to investor panic and financial instability. 3. Government interventions. Governments implement fiscal stimulus packages, monetary easing measures, and financial sector interventions to mitigate the impacts of crises. 4. Global recession. Economic downturns in major economies can spill over into other countries through trade linkages and financial contagion, leading to a synchronized global recession. 4. Responses to economic crises. 1. Monetary policy. Central banks adjust interest rates, engage in quantitative easing, and provide liquidity support to stabilize financial markets and stimulate economic activity. 2. Fiscal policy. Governments implement fiscal stimulus measures, including increased government spending and tax cuts, to boost demand and support economic recovery. 3. Regulatory reforms. Strengthening financial regulations, enhancing supervision of financial institutions, and addressing systemic risks are essential to prevent future crises. Conclusion. Economic crises are recurrent phenomena that pose significant challenges to global economic stability and development. Understanding the underlying causes, impacts, and responses to crises is crucial for policymakers, businesses, and individuals to navigate through periods of economic turmoil effectively. By learning from past experiences and implementing appropriate policy measures, societies can build resilience and mitigate the adverse effects of future crises.